So imagine you're just sitting on your couch, right? You're typing a question into your phone about what to do with your life savings.
Right, something people do every day now.
Exactly. And you get this brilliant, super confident, highly personalized answer back in like seconds.
Oh, yeah. It sounds great.
It does. But then imagine you actually follow that advice. You watch your retirement fund just totally evaporate, and then you discover that the law says it is entirely your fault.
Yeah, and that is actually the exact reality we're stepping into right now.
It's terrifying.
It really is. I mean, the technology is moving so fast that our phones have essentially become these unregulated financial gurus.
Which is exactly why we're doing this deep dive today. We're basing this on a genuinely eye-opening new article by Johan Steyn.
Right, the AI thought leader.
Yeah. His article is titled, "The Most Dangerous Financial Advisor You Have Never Heard of Is Already on Your Phone."
Such a great title. And our mission for this deep dive is to really figure out what it actually means to carry this uncertified advisor in your pocket.
Because there are a lot of hidden dangers there.
Oh, absolutely. We want to uncover how global regulators and local regulators right here in South Africa are just scrambling to catch up. I mean, this technology is rewriting the rules of personal finance before the ink on the old rules is even dry.
It's wild.
We are looking at a fundamental shift in how human beings interact with their money, and the legal structures that were built to protect them are currently they're bending under the weight of it.
Okay, let's unpack this. Because Steyn paints a very specific, very relatable picture right at the beginning of his article to sort of set the scene for us.
Yeah, the Johannesburg example.
Right. So he asks us to imagine an ordinary evening in a household somewhere in Johannesburg. There's this young professional sitting at home, looking at their finances, trying to make a pretty major life decision.
Which is, do they put extra money into a retirement annuity, or do they use that cash to pay down existing debt?
Exactly. And I mean, that's a classic financial dilemma, right?
It totally is. And traditionally, that's an equation with a lot of really complex variables.
Right. Like what?
Well, you've got tax implications, interest rates, long-term compounding, personal risk tolerance. Usually, you would take all of that to a human expert.
But instead of booking an appointment with a licensed financial advisor, which, let's be real, takes a ton of time and money, this person just opens up an AI chatbot on their phone and types the question in.
Because it's right there. It's frictionless.
Yeah. And the response arrives instantly.
Yeah.
And it's incredibly confident. It's clearly explained. It has this personalized, friendly tone. And crucially, it is completely unregulated.
That's the scariest part. Nobody licensed that advice.
Right.
Nobody audited that algorithm to certify that it is, actually qualified to tell a human being what to do with their money.
It honestly reminds me of sitting at a bar and just striking up a conversation with a highly confident stranger.
Oh, that's a good analogy.
Right. Like they lean over, they sound incredibly convincing, they give you a hot stock tip, they use all the right terminology.
But you don't know them at all.
Exactly. It sounds like great advice, but you would never go home and bet your life savings on it because it's just some guy at a bar.
Right.
But with these chatbots, because the information comes through this sleek interface on a high-end piece of glass, we afford it this completely unearned authority.
We really do. We trust the tech.
We do. But I want to push back a little here, just to play devil's advocate. Let's look at the actual mechanics. If the advice the chatbot gives is technically correct, say, the mathematical calculation on the debt repayment is flawless. Does it really matter if it came from a machine rather than a human?
What's fascinating here is that the law says it matters immensely, and for a very specific reason.
Oh, really?
Yeah. The entire regulatory framework for financial advice in South Africa was built around human accountability.
Wow.
The fundamental premise of the law is that consequential financial guidance must come from an authorized human being who has a legal obligation to act in your best interest.
Ah, you're talking about the Financial Advisory and Intermediary Services Act, the FAIS.
Yes, exactly, the FAIS Act.
Mm-hmm.
So think about how a human advisor operates under this act. They're a representative of a licensed provider.
Right.
Before they give you any advice, they have to do a comprehensive needs analysis. They have to understand your age, your dependence, your income security, your risk appetite.
So they actually have to know you.
Exactly. And this is the really critical mechanism here. There has to be a documented record of why they gave you that specific advice.
A paper trail.
A paper trail. That record must be capable of being examined, challenged, and if the advice was negligent, it can actually be the subject of a formal complaint.
So the law is actually designed to introduce a bit of friction. It forces the human to, Slow down, ask probing questions, and leave that paper trail.
Precisely. If a human advisor gets it wrong and causes you financial harm through negligence, you have a clear path to justice.
You can take them to the ombudsman, right?
Right. The ombudsman for financial services providers, there's a whole architecture of redress. But when you look at the chatbot, it satisfies literally none of those requirements.
None at all.
It's not licensed. It has no legal obligation to suitability. Fundamentally, a chatbot doesn't even have a client. It only has a user.
Because it only knows what you volunteer in that little text box.
Right.
Like, if you don't explicitly mention you have 3 kids and a precarious freelance job, it just doesn't ask.
It doesn't ask and it doesn't care. And because you are just a user of a software product, the chatbot cannot be held to account by the Financial Sector Conduct Authority.
Wow.
So if that algorithm tells you to liquidate your savings to pay off a specific debt, and that turns out to be a disaster for your tax situation, that whole architecture of redress just evaporates. You have no ombudsman to call.
You're just on your own.
Completely on your own.
Man, this lack of individual accountability for the chatbot, it really leads us into a broader, almost systemic panic.
Oh, for sure.
Because if these models don't answer to the FAIS Act, who is policing them? Like, what are the regulators actually doing about this on a macro level?
Well, they're openly acknowledging that the current rules are failing. I mean, Steyn's article highlights the sheer scale of this panic globally.
Yeah, let's talk about the global stuff first.
So just this past spring, the UK's Financial Conduct Authority published their annual perimeter report. This was March 26th, 2026.
And a perimeter report is exactly what it sounds like, right? The regulator surveys the boundary of their legal power to see what's slipping past them.
Exactly. And in this report, they explicitly flagged the growing use of general-purpose AI for borrowing, saving, investing as a major risk, operating completely outside their regulatory remit.
So they're essentially just throwing their hands up and saying, we don't have the jurisdiction to police this yet.
Basically, yeah. And they're calling on the government to urgently update the rules. They even followed that up with the Mills Review back in January 2026, looking ahead to 2030.
What were they asking in that review?
They asked a very pointed question. Are these AI systems providing services that are functionally identical to regulated financial advice while remaining totally untouched by the law?
Which brings up the concept of agentic AI. The Digital Regulation Cooperation Forum issued a big warning about this, and it's a crucial distinction we need to explain.
It is. It's the difference between a machine talking to you and a machine acting for you.
Right.
Conversational AI, like the chatbots most people use today, will just give you a list of recommended index funds. Agentic AI is an autonomous agent.
That's just more than just recommend.
Way more. It doesn't just recommend the fund, it actually logs into your brokerage account, authenticates itself, and executes the trade on your behalf.
It takes the action. That's huge.
Yes, and it is capturing huge value while sitting completely outside the regulatory perimeter.
So what does this all mean for the financial companies actually building this stuff? If regulators are admitting the perimeter is broken, are the tech and finance firms just flying blind?
We actually have hard data on this from South Africa, and it paints a highly concerning picture.
Oh, tell me about that.
So late last year, November 2025, the FSCA and the Prudential Authority published a joint report on AI in the local financial sector. Okay.
They mapped the industry by drawing on over 2,000 survey responses. This covered banking, insurance, investments, payments, and lending.
Wow. So that's a comprehensive snapshot of the entire financial ecosystem here.
It really is.
Yeah.
And the findings highlight a terrifying unevenness in how this technology is being managed.
How so?
Well, banks are leading the charge. 52% of them have adopted AI in some form. But when you look at the governance frameworks, the internal safety checks, it completely falls apart.
Oh, no.
Yeah. 20% of fintech firms reported having absolutely no AI governance at all.
Zero.
Zero. None. And across the entire board, only 5% of firms reported having mature oversight frameworks.
Wait, really? So you have companies deploying financial algorithms to the public, and 20% of them have no internal rules governing how those algorithms make decisions.
Exactly. Which creates a massive vulnerability known as the explainability gap.
The explainability gap.
Yeah. The FSCA's fintech specialist highlighted this as a critical failure point operating in plain sight. Let's break down the mechanics of that explainability gap for a second. Because a neural network isn't like traditional software.
Right. Traditional software is built on logic trees. If a user inputs condition A, the software outputs result B.
It's predictable.
Totally. A human engineer can open the code, trace the path, and explain exactly why the software made a decision. But modern AI, specifically large language models, they do not work that way.
How do they work then?
They ingest billions of data points and probabilistically generate responses based on weights and patterns that are constantly shifting.
Oh, man. It's like going to a doctor who prescribes you a very intense medication, but when you ask why they chose that specific drug, they just shrug and say, well, the computer told me to.
Wow, yes.
Like, you want the doctor to explain the diagnosis. You want to know the why.
That is the perfect analogy. An AI model can give a consumer an answer that is technically accurate, but if the institution running that AI cannot explain to the consumer how the AI reached that decision,
Like, what specific financial factors it weighed.
exactly, or how it calculated their risk profile. If they can't explain that, then it is a massive consumer protection failure.
Right.
If the algorithm denies a loan or recommends a portfolio shift, and the human engineer at the fintech company cannot explain the mathematical reasoning behind it, you cannot govern it.
And if you can't govern it, you cannot protect the end user. But this black box of AI decision-making doesn't hit everyone equally. The people downloading these free apps aren't exactly the ultra-wealthy.
Yeah, they're not.
Which brings us to the core conflict here. Who exactly is getting hurt by this invisible gap?
It all comes down to the advice gap.
Yes, let's talk about South Africa's structural advice gap, because it provides the entire context for why this AI explosion is happening in the first place.
It does.
Historically, the whole concept of licensed, regulated financial advice has really only been accessible to the middle and upper markets.
Because to get a human advisor, you usually need a certain amount of investable assets.
Right. That means large portions of the South African population have been entirely excluded from ever receiving formal guidance on their retirement savings, managing their debt, or navigating insurance.
It's tragic, really. The people who most desperately need sound financial guidance to build basic economic resilience are the exact same people who are priced out of the regulated market.
Here's where it gets really interesting. AI steps into this exact void. It's like we're finally building a bridge to an isolated, unbanked island.
Oh, I like that.
Right. For decades, these consumers have had no access to financial expertise. Suddenly, technology builds this massive, free, instantaneous bridge so everyone can get guidance, but they forgot to put any guardrails on it.
That is a brilliant way to put it.
AI is democratizing access to financial knowledge, but it's simultaneously stripping away the FAIS Act, the Ombudsman, the suitability, checks all the very protections that made that guidance safe to consume in the first place.
Yes.
But I have to play devil's advocate again, though. Because if someone is drowning in high-interest credit card debt, isn't a chatbot telling them to consolidate and pay it off better than them getting absolutely no advice at all? Aren't regulators just letting perfect be the enemy of good here?
Well, if we connect this to the bigger picture, the dynamic becomes much more dangerous than a simple credit card recommendation.
Okay, how so?
Wealthy, financially literate consumers, the ones who already have human advisors, they usually understand the limitations of a chatbot.
Right, they know it's not perfect.
Yeah, they might use it to summarize a market report or bounce ideas around, but they know it's just a machine. The real danger is to the vulnerable consumers who don't realize the chatbot doesn't actually know them.
It doesn't know their risk profile or their employment security.
Exactly. They are reaching out for help for the very first time. And to them, the highly polished, confident tone of the chatbot sounds like absolute authority.
They just don't have the financial literacy to spot a hallucination.
No, they don't. The machine might tell them to surrender a life insurance policy to pay off short-term debt, completely failing to factor in the tax penalties or the loss of long-term cover for their dependents.
Oh, wow.
It is filling a genuine gap, yes, but it's filling it with an illusion of competence that has absolutely no safety net.
So, for you listening to this right now, think about how easily someone you know, maybe a younger sibling, just starting their first job, or an older relative trying to figure out a complex pension payout, think about how easily they could mistake a chatbot's financial-sounding content for actual, legally bound financial advice.
The line is incredibly blurry.
It really is. But of course, when vulnerable people get hurt, the financial harm is real. And when financial harm is real, the lawyers inevitably get involved.
Oh, they always do.
So how are the courts and regulators preparing to assign blame when an unexplainable algorithm destroys someone's savings?
Well, the liability landscape is hardening way faster than most executives realize. The era of tech companies treating AI as this legally immune Wild West is coming to an abrupt end.
Yeah. Steyn's article details several global precedents that prove this isn't just an academic theory anymore. Like, real companies are paying real money.
Look at Air Canada.
Yes.
Yeah.
A customer service chatbot hallucinated a bereavement discount policy that didn't actually exist and promised it to a customer.
And Air Canada actually tried to argue in court that the chatbot was a separate legal entity responsible for its own actions.
Which is wild, and the tribunal rejected that entirely. They forced the airline to honor the hallucinated discount.
Right. And then you have Tesla continually facing liability for the failures of its autonomous systems.
And just recently, in March 2026, a California jury held Meta and YouTube liable for algorithmic harm, awarding $3 million in damages.
3 million. Those precedents establish firmly that you cannot separate the output of the algorithm from the corporate entity that deployed it.
And we're seeing severe consequences locally as well, right? The FSCA has raised huge alarms about deepfake videos,
Oh, the deepfakes are terrifying.
where prominent South African figures are artificially generated to endorse fraudulent investment schemes. That specific pattern of AI-generated fraud was directly linked to the final liquidation of a South African financial provider.
It's doing real damage.
But let me challenge the corporate mindset here again. Can't a tech firm or a finance executive in Johannesburg just sit back in their boardroom and argue, well, there isn't a specific AI act on the books in South Africa yet, so we aren't legally liable for what our experimental chatbot says?
This raises an important question, and the short answer is, if any board of directors is relying on that defense, they are making a catastrophic corporate mistake.
Really?
Yes, they absolutely cannot hide behind the lack of a singular specific AI law.
Because what existing laws are going to catch them?
Let's look at the incoming legal avalanche. First, South Africa's draft national AI policy was gazetted just a few weeks ago, on April 10th, 2026.
Okay.
That policy explicitly identifies consumer-facing AI systems in financial services as high-risk applications.
And high risk means you don't get the benefit of the doubt.
Exactly. That designation alone means heavy regulatory scrutiny. Then you have laws that are already fully active, like POPIA, the Protection of Personal Information Act.
Okay, POPIA. Most people think of POPIA as just a data privacy law.
They do, but it has extremely stringent requirements around automated decision-making. Under POPIA, consumers have the legal right to understand the underlying logic of a decision made about them by a machine.
Oh, remember the explainability gap we discussed earlier?
Yes, the black box. If a financial firm uses an AI to process your data and make a decision, and they cannot explain the mathematical logic to you, they are already violating POPIA.
Wow, I hadn't even thought of that.
And furthermore, the FSCA is bringing its Conduct of Financial Institutions Bill, or COPI, to Cabinet in 2026.
How does COPI change the game for these algorithms?
Well, COPI fundamentally shifts regulation from a tick-box compliance exercise to a principles-based model. It's entirely focused on treating customers fairly. So if an institution is using an AI channel to engage customers, and that AI is generating unregulated financial guidance, the institution will have to prove that the system is producing fair outcomes.
And you cannot prove fairness if you don't have audit trails.
Exactly. You can't.
So Steyn is essentially issuing an executive ultimatum here. The strategic question for financial boards isn't whether they should use AI, because the technology is incredible, right?
All right.
It has the power to dramatically reduce costs and reach those underserved markets we talked about.
Absolutely.
The real question is whether their internal governance architecture can survive contact with the law.
Do they have audit trails? Do they have a clear escalation path where a user interacting with a chatbot can hit a button and just say, stop, I need a human to review this?
Right.
Financial institutions must anticipate that regulators are drawing a line in the sand. You simply cannot bypass human accountability just by wrapping it in a sleek technological interface.
Because unregulated financial guidance causes real harm. We have a genuine structural advice gap in this country. And while AI absolutely has the potential to narrow that gap and bring huge socioeconomic benefits, it has to be done through careful governance.
Not by bypassing it.
Exactly.
Yeah.
Bypassing the rules doesn't democratize finance, it just democratizes risk. Right now, the chatbot in your pocket is generating highly convincing financial-sounding content, but it is fundamentally incapable of providing true regulated financial advice.
And that distinction is everything. But I want to leave you with a final thought, building on Steyn's premise and looking ahead to where this is all inevitably going.
Okay, let's hear it.
Let's imagine a future where regulators and financial institutions actually succeed. They close the explainability gap, they build the perfect legal framework, and an AI eventually becomes a fully licensed, legally accountable financial advisor.
Okay.
A machine that completely understands your entire life context, your taxes, your family structure, and executes perfect agentic trades on your behalf.
That would be amazing.
It would. But if that happens, will human financial advisors become completely obsolete? Or will we end up in a divided world where a perfectly governed AI manages the money for the masses, while human advisors become a luxury status symbol, reserved only for the ultra-wealthy who can afford a human touch?
Wow. Wait, really? Are we just replacing the old advice gap with a new kind of digital divide?
It's definitely something to think about.
It really makes you look at the device in your hand a little differently. Well, thank you so much for joining us on this deep dive. As you go out your week, keep questioning the algorithms in your life. Remember, that highly confident stranger in your pocket might sound like they have all the answers, but until the guardrails are fully built, it's still just a stranger at the bar.